This segment is going to cover investment risks that investors face. As you know, really our returns are related in general to how much risk we were willing to take from an investment perspective. So you'll see high risk statements like higher risk, higher return. And so the reality is that no matter what we invest in, we are taking some level of risk. And so if you are recommending investments to your customers, then they need to make sure they understand what investment risks they are facing. And in the market, there are a number of investment types of risks that you should be familiar with and your customers should also be familiar with. So we're going to spend a few minutes looking at these types of risks and making sure you understand what they are. So in general, when we are investing, we're investing in the economy as a whole. So the economy is going to impact the returns on our different types of investments. If the economy is booming in good times, then everything tends to be positive, and so the marketplace is increasing and we are in a good positive economy, and so our risks of investment are not as negative, if I can use that term, as if we're in an economy that's not in a good shape. You can know different places in the world, different economies today, in Greece, in Syria, and some countries, not probably a good place to invest because the economy as a whole is not doing very well. And so when we're investing, we need to take into account the economy. The beauty of the world today, however, is just because we live in Canada doesn't mean we only have to invest in the Canadian economy. We have the ability to invest in any economy worldwide through seg funds, mutual funds, and other types of investments. So our risk of investment impacted by the economy as a whole. Second point, market risk. And so how is the stock market doing? Is the market on an upward trend? Is it on a downward trend? When we invest in the stock market, we are taking market risk. And so if I am going to take some risk, I would expect that I should be compensated for taking that risk. If I put my money in a GIC and it's paying me 3%, I'm actually taking no risk because that GIC is going to give me 3% and it's guaranteed. So if I decide I'm going to put something in another type of investment, I would hope that that investment is going to give me back more than a guaranteed return of 3%. If it isn't, why should I take the additional risk? So I need to be paid and be compensated when I invest for the additional risk that I'm taking. And so market risk is the risk of the market. Industry risk. I may be taking risk if I'm investing primarily in the automobile industry, or I'm investing primarily in the banking industry. And so when I decide to invest specifically in that industry, I am taking on industry risk. Inflation risk. As we talked about earlier, inflation is the decreasing purchasing power of your investment. So if I were to buy a GIC and the GIC is going to pay me 2% per year of interest, well, that's great. But if inflation happens to be 2% that year, at the end of the year, even though I earned 2% more because that was the interest rate I was earning, because of inflation, I am no further ahead. In fact, my purchasing power is exactly the same. So technically, I haven't made any money. I haven't made any more money to cover the risk of inflation. And so when we think about inflation risk, we think about things like GICs, certain bonds, because our interest rate is fixed. These types of investments, we are going to incur inflationary risk. Interest rate risk. Interest rate risk applies primarily to bonds and a long-term investment. So when I lock away interest rate, let's say, for example, I'm going to invest my money in a 5-year GIC and they're going to pay me 3% for the next 5 years. I have locked away that return. My money is locked away for the next 5 years. If interest rates go up, I'm actually losing out because I've taken interest rate risk in that if rates go up, I don't get in on the higher rate. The alternative is, however, still good for me because if rates start going down, I in fact have locked in today's higher rate. So when we take an investment that's giving us a guaranteed return over a certain period of time, we are taking interest rate risk. Liquidity risk. Well, as we said earlier, liquidity is the ease of getting at our money. And so if I invest in real estate as an example, I am taking liquidity risk because I can't convert my real estate investment into liquid cash within 2 or 3 days. So liquidity risk means that investment is locked in and it's hard to convert into liquid cash. You might have liquidity risk, for example, in certain stocks. If you have a stock that nobody wants, it's not traded very frequently, and you decide you want to get rid of it, you may not be able to sell it to anyone. And so what may happen is the price will have to keep dropping until someone says, okay, it's a low enough price that I'm willing to buy it at that time. So just because we have a stock doesn't necessarily mean it's liquid. Next item on the list there is foreign exchange risk. Anytime we invest in a foreign company, a company that's not domestic, not in Canada, we are taking currency risk. So if I'm going to invest in a company in the United States, then I'm going to take a currency risk between the change in the US dollar exchange and the Canadian dollar. So foreign exchange risk is a risk I take when I invest in companies outside of Canada. And the last item on there is called credit risk. You'll see the word default risk also on there. And what that really means is that if I lend my money to somebody, and credit risk primarily works around bonds. I've lent my money to a company but in the form of a bond, and if that company defaults on the bond, in other words, they don't have money to pay me back when it's due, then I am taking on credit risk. And in fact, bonds are rated. The higher the rating of a bond, for example, the bond from the federal government of Canada is very highly rated, and so I'm going to take very little risk if I lend my money to the government of Canada. However, if I lend my money through a bond to some other company that is rated BBB, lower down the level, then I'm going to take on more risk because they may not be able to pay me back. However, because they're rated lower down on the list, in order for me to lend them money, they're going to have to pay me a much higher interest rate than the government of Canada. So the ratings of bonds determine the interest rate that they are going to be paying the investor, but it also determines the risk that that investor is taking. So that's it for our risks of investing.